Hello guys, welcome back to your channel. Hope you are enjoying with your profits, but today we have come with a topic which will help you to save your profits. The topic name is portfolio diversification. What is portfolio diversification? Let's understand with an example. A famous quote is there in the market that you should not put all your eggs in one basket, because if the basket falls, you will lose all your eggs. Here eggs is your money, okay, and your money should be placed in different baskets. By baskets we mean that your every penny should be in different instruments, okay. For example, there are many various instruments where public invest their money in. For example, the bond market, the securities market, the fixed deposit, and the gold, many other instruments, okay. So how you will manage, how you will diversify your portfolio depends on certain conditions, certain your age groups, and many other factors we will learn a little later. But first you need to know that you should not or never put your money in any one instrument. Means you should not put your money in a fixed deposit even, because nothing is safe in this world completely. If the bank suffers a problem, your fixed deposit also go with the problem, okay. So today we will start with how you should diversify, how much quantity you should diversify, because again, too much diversification also impacts your return.
Absolutely.
Okay, so let's start with Rohit sir will explain you how to diversify your income, okay.
Yes. So to begin with, you must first consider the factor of the age. If, for example, you're in the 20 to 30 age group, then you have just begun your career and you are willing to take more risks. You should be willing to take more risks at this age profile rather than a 60-year-old person. So if you are willing to take more risks, you can allocate a major chunk of your portfolio into a high risk, high yielding equity asset class. So equity asset class, for example, is actually a higher investment grade portfolio in which you should keep limited exposure. Generally, this is what people say.
No, let's quantify for our investors, because they are very new to the market. So let's quantify. For example, if a person has 100 rupees, how much exposure that he should put in his equity investments, means equity shares like Reliance, TCS, any company, any good company.
So
how much is the amount of that money?
Yes, so in common parlance of investment, if, as I said, if you're in the 20 to 30 age group, you could think of investing around 60% in the equity segment, and the balance 40%, you can say that you can invest another 30% in the debt or bond markets, and the rest 10% you can sit on cash to cover up various opportunities which may come in future.
So let's write down like this. First, if you are in that age group, you should invest 100 rupees multiplied by 60%, that is 60 rupees in the equity market, okay.
Yes.
But always remember, equity market comes with a risk, okay.
Yes.
Risk is in every asset, but
In search of getting higher returns,
higher risk.
yes, you will have to bear higher risks. So it's, since you are in a younger age group, in case of any problems or in case of any mishappenings, you have the time to rebalance yourself and come back on your feet. But in case if it is a senior citizen who is living on pensions and who earns a very limited amount of income in his life, he does not have that time to work again and stand back on his feet in case a huge amount is lost in his investment profile. So he should always keep focusing on the safer investment options available, which
Basically,
include, yes, the
basically
bond and
the
the
fixed income group.
Yes, the fixed income group.
Okay,
segment.
great. So that's fine, but there is a basic understanding which everybody does not get it, that there's a difference between a total capital and a risk capital. Okay,
Exactly.
people often have the misconception that whatever their money is in their hand or in their bank account or in their home, that is their risk capital. No, there is
Very
a
wrong.
difference, because if you have this misconception that your total capital and risk capital is same, then you might land up in big trouble.
True.
Because
That is how
what-
people get
what-
bankrupt
yeah,
and
yeah.
come on the streets. by betting
what
everything
money
which they
we
have.
are talking about that you will invest is your risk capital. Okay,
Yes.
you will invest your risk capital in the markets, because you should never ever invest the capital which you need for earnings. Okay?
And quantifying risk capital is an individual decision. If you have a net worth of 100 crores, you can quantify a higher risk capital. But if you have a net worth of 1 crore, then of course your risk capital will be very less, depending on the assets which you have created in life and the goals which you want to create in future also. So your risk capital will depend on all those decisions too.
Okay, great. So now we have understood in this video by now that how to manage, differentiate between a risk capital and the total capital. We understood how you will invest, what you will invest in equity shares, but everybody is not comfortable today in equity markets, because it may be any reason that they feel that it is a riskier asset, it is a very high volatile asset that they cannot track. So what is the other instruments which they should invest by to diversify the portfolio, so in case that the equity market goes down, they can at least have some income from the other asset class?
So basically, a lot of asset classes have an opposite correlation. Now, this term may be new for a lot of people. So correlation basically shows, in the literal term, relation between two things. So, for example, equity and gold have somewhat a negative correlation in a larger period of time. If the equity markets are rising, then the gold markets generally tend to stay stable or even fall on the downside. So if your equity investments are higher and suddenly the market crashes, then your fund is at a very big risk. So if you diversify with a portion of investment in the gold assets, then if your equity portfolio comes down and in the search of safe haven, the prices of gold increases, then your portfolio will have a certain hedge and your net return will be better than the market returns.
So that's very beautiful concept, because even you can use that gold to wear it in a party, in a normal day-to-day life. So it will serve multi-purpose. Okay, so equity, there is equity, there is gold, and what more instruments? A famous instrument everybody which uses is fixed deposit. So
Yes.
how much fixed deposit you should keep? How much in what is the process where they should keep?
So basically, fixed deposit investments should be done in a very limited amount. What we suggest, people who don't have knowledge about investment decision making, they park all their funds in the fixed deposit. But fixed deposit investments are not wealth building assets. If you really want to build wealth, and if you want your money to work for you while you sleep, then you should follow a very systematic approach of investment in all asset classes, including the fixed deposit. The fixed deposit asset class should only be there as a temporary parking zone for funds when required to be invested in other asset classes like equity, like mutual funds, or like other various asset classes in case of the crashes or price falls. So fixed deposit is just there for parking your funds for a temporary period of time till you find another good idea of investment.
So, sir mentioned a very important point, that while you sleep. So, what is that point? That point is simple, that there is a famous quote, okay, in the market, that if you don't have that ability to make money while you sleep, then you might have to work until you die. Okay, this is another concept called passive investing, and you should have it fixed deposit, but make sure by while investing in the fixed deposit, the government guarantees only up to rupees 5 lakh per deposit. Means if there is a bank run, if there is a bank goes bankrupt, the government assures you that if you have a 10 lakh fixed deposit, or you have a 100 lakhs fixed deposits, or you have 25 lakh fixed deposit, but the government takes guarantee of only 5 lakh rupees fixed deposit. Okay, the government doesn't guarantee the entire amount. So risk is in the fixed deposit also.
Exactly.
Okay, many people are not aware about it.
Yeah. Our central bank, Reserve Bank of India, has done a very good job over the past many years to maintain the reserves and the capital adequacy ratios of the commercial banks, which ensure that these banks don't fail. But then there have been many instances in the recent past which involve cooperative banks and even a very well-known private sector bank,
So um, we have
which
learned
has
about the
actually
fixed
fallen.
deposit also. And what are the more instruments like the bond markets, the mutual funds? How should they look at that also? Just a little bit.
So the bond markets play a very major role in hedging your portfolio against various risks. Bonds are basically instruments offered by banks, be it the Reserve Bank or the commercial banks, and also by companies. Companies and banks who offer bonds basically get ratings, and on that ratings the interest rate is defined. So while a bond is like a fixed deposit only, where public invest their money in the respective bond and earn a fixed interest on that amount invested per
And
annum.
when we talk about risk, even the bonds are not 100% safe, right?
Absolutely, there
Even
are
the
ratings.
bonds
Some bonds are rated AAA, some bonds are rated AA, and some bonds are rated B. There are ratings given to these bonds. The higher the ratings, the lower the interest rate, because higher ratings means there is a less amount of risk involved. Risk means default risk involved, and hence the interest rate is low. If you are going for a very low rated bond, then your interest rate given will be very high, but at the same time, the default risk will also be high.
in the recent times, there's a famous fund. We will not take that name, but they couldn't repay the money instantly because
Yes.
there is a huge redemption pressure.
Yes.
But so any bonds is not safe, not any fixed deposit not safe. Basically, no asset class in this world is safe. Not even your cash is 100% safe, because if suddenly one day demonetization comes, your entire cash is gone. So this is just for fun, but nothing is safe in this world 100% safe. Okay,
There is
so
just
you should
basically
diversify your.
there is actually one safe form of investment which is offered by the government of India, and these schemes are basically public provident funds and Sukanya Samriddhi schemes. These funds come with a sovereign guarantee. What is a sovereign guarantee? That means that even in case of default, the government will print banknotes and then give you the money back. So these are the only safe investments available, but then they offer a fixed interest rate and their lock-in periods. That means you have to keep your funds invested for a fixed tenure. You cannot withdraw that. So those tenure may be
But
10, 15 years or 5
but
years.
that carries also a risk. Okay, just for example, let's take it a Pakistan. If you are in a Pakistan and you that is your government, that can government can also go bankrupt, and you will not get your money back. Okay, so I don't think that is also 100% safe, because everything has a 1% risk. Okay, so if the government fails, your money is lost. Okay. So you should always keep diversifying your portfolio in the quantum that sir said. You should
Yes.
maintain that. So what is
So
the
that if
final-
one egg breaks, the other can feed
Yeah,
you properly,
yeah,
and your
exactly.
stomach is always full.
Exactly. So what is the final concluding remarks for them?
So the concluding remark is that you should first quantify your goals and your age profile and your risk appetite, and then choose various asset classes, balance it out between, say, equities, bonds, and fixed deposits, and also diversify some money into gold. The investment in gold can be physical jewelry or the sovereign gold bonds offered by the government, which earn you a fixed rate of interest also per annum, or maybe gold mutual funds or ETFs. There are lots of modes of investment, but these broad asset classes should be looked into. Also, real estate investments is a good option, but given the fact that the liquidity is very low while reselling and you may not get back a very good value, you should also stay cautious for
Let's make
investment
clear
into real
what-
estates.
Let's make it clear what is liquidity. What sir said. Liquidity is simple thing where everything which you have in hand, it is easily sellable to anybody else. For
Yes.
example, in the stock exchange, you have enough ample liquidity. You have a Reliance share. You press the sell order button, and it suddenly gets to another
Sold.
person in the stock exchange. Okay, but let's take example of real estate. If you want to sell a building or a flat of 5 crores, 10 crores at any
Yeah.
location in Calcutta, India, or anywhere,
You cannot sell
there is
it at
not
one click.
immediately. There is no buyer. Okay,
Yes.
right? You have to search for buyers, and then it will take
It may
time.
take days or months
That is
also.
called liquidity. Okay, so that's it for today, and hope you liked our show. And if you liked, you may subscribe, spread the awareness. It's absolutely free, because you take no effort in subscribing and sharing with your friends. And also mention in the comment box that what new topics you need in the upcoming future so that we can work upon it. Thank you. Till then, take care and bye bye.
Keep investing. All the best. Enjoy your profits.